and thank you for attending this evening. And this is going to be really worthwhile, in my opinion. As we all know, pharmacy is going through some serious funding issues at the moment, and we are roughly 1.5 years into the current 5-year pharmacy contract deal. And we are all working really hard all the time, all the hours under the sun. But what we really should be doing is working smarter and preparing for the future and knowing your numbers on where to save money, where to invest, and getting our businesses ready for selling and retiring. And I can thoroughly recommend Ashwin is a great guy with a brilliant knowledge, especially in pharmacy. His company is called Pharma Wealth. He specializes in working with pharmacy. He will be able to answer most of your questions, although we have limited time. So if you do have any questions, please put it on the Q&A at the bottom of the Zoom. Ashwin will try and answer most, and any that he can't answer, he will get back to you and answer those. And over to you, Ashwin.
Anil, thank you so much. Anil, thank you for that introduction. I really appreciate that. Ladies and gentlemen, thank you so much for joining us this evening. I appreciate it's been a long day, so I've got to ensure today's subject matter will really assist you in the things that you want to do going forward. So with no further ado, I don't want to waste any time, ladies and gentlemen. We've got a lot of things to get through, so I'm going to move at quite a pace. As Anil has requested, please put your questions and answers in the chat box, and when we get to the appropriate section, I'll pick up on that and I'll answer as many as I possibly can, and if I can't, we'll come back to you thereafter. So one thing just to let you know, as of about 2 o'clock or so, all of you that were registered, we've emailed all of you, and from relationshipexecutive@farmerwealth.co.uk, and there's a response sheet in there. So I'll talk to you about that towards the end of time today. So moving on, Simon, can we have the next slide, please? And one more, please. Lovely. So what are you going to know today? Well, when it comes to the 3 most important areas, Joe, next slide, Simon, next slide, please. I said, I think I put a promo video together, and I said there were the 3 most important things that you have to get correct in order to ensure your financial resilience, ensure you gain and maintain financial resilience. And I'll go through them very quickly with you, just as top level, and then we'll dive into it. First thing is retirement planning. What's important about retirement planning? What's important about retirement planning is that you have the right assets in the right place at the right time, generating the right income for you to have a comfortable retirement income. And of course, when we are no longer here, often we may have a spouse that's left behind. We want to make sure that person is still catered for from our planning. So retirement planning, number 1. Next slide. Selling your business. I know the average age of the independent contractor is of a time now where a lot of people are considering selling their business. Selling your business is really important that you make sure your affairs are structured so that prior to the sale, you maximize the amount of cash that you will receive or that we will receive, and we pay the least amount to the inland revenue. You have to get the structure of things correct now before you sign on that dotted line. It's a bit too late then. Next slide, please. And the third area that's really important is to ensure your life's work is protected. Many of us have worked for decades, having paid all manner of taxes, income tax, corporation tax, capital gains tax, VAT, etc., all manner of taxes. And then at the end, when we pass away, many of us will pay the final nail in our coffin is that 40% inheritance tax. So we're going to talk about how do you protect your life's work, and we're going to discuss the way you do that is through having the correct framework of wills, trust, and estate planning for your circumstances. So once again, you cut out the unnecessary tax and leave the maximum benefit of your life's work to your family. Next slide, please. So What's the most important thing at the end of today's presentation? Is that you take action now, not later. Why? I've worked with pharmacists for over 26 years and nearly 30. I'm in my 30th year of financial planning. So I've done 30 years advising clients, and 26 of those years has been exclusively with pharmacists. And the one thing I know about pharmacists, or the few things I know about pharmacists, is they work hard and they save hard. So they're asset rich. However, due to the nature of their business, they are often time poor. So if during our presentation today, something strikes a chord, I will give you an opportunity at the end where you can say, right, we want to talk to these people. Let's make that decision now and let them know so we can start this dialogue with you. Because unfortunately, later doesn't come with the pressures of your job. Next, please, Simon. So what are you going to have, Simon? I'll do this, Simon, instead of saying, you're going to have an easy way to make what we discussed today happen for you. We're going to make it easy for you to get a one-to-one meeting with me if you so wish. What will you feel if you get all these things in place? You'll have peace of mind. And maybe you'll sleep like a baby, knowing that your family is protected. But you know what the problem is? The problem is that actually you are successful. And your success is about your endeavors. So it's not always the case that people who work, put the time in and the effort in, experience some form of financial significance. It's actually the case, sorry, Simon, I moved on a bit too quickly. It's actually the case, Joe, can you scroll down so I can see the notes? Sorry, it's actually the case that because you're entrepreneurs, it's your time, your effort, and your business acumen that has contributed to your financial success. And the real problem is that the revenue don't necessarily recognize that, and I'll show you why. In 2018-19, this is the information I'm going to share with you today is what I picked up that was published on 28th of October 2020. In 2018-19, the revenue collected just under 228 billion. Apologies, Simon. Next one, Simon. Apologies, ladies and gentlemen. The revenue collected 228 billion of taxes. That's the government's income. However, they have a terminology, and it's called managed expenditure. They collected 228 billion, but they spent over 850 billion, which means they had a deficit of 224 billion pounds in one tax year, ladies and gentlemen. That's 2018-19. What about the previous tax year, 17-18? 229 billion deficit. Now, ladies and gentlemen, I can produce lots of figures, and that's not the objective of today. It's what I'm trying to do is highlight the scale of the problem. So the scale of the problem is this, that the UK government is spending far more money, significantly more money than they're collecting. And the challenge with that, ladies and gentlemen, is this, is that how are they going to plug that deficit? Because this is just the last few years, never mind about the national debt accrued from decades and decades. And as you all know, we're in this period of COVID again. I say COVID again, it's COVID. And you know, it's hundreds of billions that we're running into of money that we've spent that we don't have already, in addition to the regular money that we've just seen 2 slides on. So I'll tell you where I think this money is going to come from. It is not coming from the people that you and I employ. It ain't going to come from them. They're on a fixed wage, a fixed income, and they make up over 95% of the population. So if you actually think about it, the people that we employ make up over 95% of the electorate. These are the people that vote governments in. Less than 5% of the people in the United Kingdom are people like you and I, who are the entrepreneurs, who take so many risks, we pay income tax, we pay corporation tax, we collect VAT on behalf of the government. Okay, I know in pharmacy is a lot less VAT, but as a generalization, the entrepreneurs collect VAT on behalf of the government. We are often the higher end of income as well. Therefore, we pay more income tax, more national insurance, we're paying more VAT because of all the money we're spending, etc., ladies and gentlemen. So I'll tell you something. If we only represent 5% of the electoral, it means that we are likely to be the ones they're going to try and get that money back from, because they cannot get it back from the general public. They just don't have that kind of income, firstly. And secondly, they're the ones that vote them in power. So, what I'd like to say to you this evening, none of us, despite your success, none of us plan to fail. None of us plan to fail. But those of us who fail to plan, that's what we're going to be doing. We're throwing money out the window. And guess what? There's the greedy revenue. They're picking up every single penny that we throw out the window and every single penny they can get their hands on. So, what are your needs? You as contractors, what are your needs? I said there were 3 areas that we need to look at. Let's look at the first area, selling your business if you happen to be at that part of your life. Well, what will your needs be? Well, you want to know, how much am I going to get for my business? You'll want to know, how much tax will I have to pay? And finally, how much of the proceeds can I keep? Is that it? Next slide, please. Another need that we've talked about, retirement planning. So when it comes to retirement planning, you want to know the income I get is what I've got. Sorry, what you want to know is from your existing assets and savings, is what I got going to be enough to generate me the right income in retirement? And of course, ladies and gentlemen, inflation proof. That's really important. The next thing you'll want to know is, how do I best draw that income to be tax efficient? The final thing many of us want to make sure is that when we are no longer here, did we leave our spouse in a comfortable position to continue with the lifestyle we've had for however many years? Next slide, please. Right. And then, of course, we've got that third area of, how do you protect your life savings? Well, inheritance tax is the red marker in the naughty teacher's book where they write in red telling you what we've done wrong, etc. Well, you know what? The revenue will put a red pen through our estate, and they'll want to collect as much as they possibly can. So we want to make sure, when we come to inheritance tax planning, that we make sure our assets go to the ones we want it to go to. So who's going to benefit from our assets when we die? That, by the way, ladies and gentlemen, we need to plan today, because we don't know, none of us know when we're going to pass away. None of us know that. So we need to plan that now to make sure, if it happens before we would naturally expect, these questions have been answered. So who's going to get our assets? How much tax will our family pay? Is it fair, that tax? I'm not certain, if I'm honest with you. I really am not certain. For those of you who are very happy, once you understand what the tax bill is, as it is today, without any planning done, if you're happy for your family to pay that, I accept that. But there are people out there that don't mind their family paying whatever the amount of inheritance tax is. But I think my experience tells me many more of my clients, like you and me, I want to legitimately pay the least amount of inheritance tax. And the reason for that is that I've paid significant income tax, corporation tax, capital gains tax, all those taxes, all these years. And I think that I've paid more than I'm going to get out of the system, including that inheritance tax. So for me, I don't think the system's fair. And then finally, obviously, what are your needs? What can we do to minimize that tax payment? So normally, ladies and gentlemen, when I put together a presentation like today, I will ask the audience, why are you here today? What are your concerns? What are your worries and fears? However, as you know, we don't have the time to do that. This technology may not be the best way to do it. So, wonderful. What I've done, ladies and gentlemen, and I don't know if you can see that. I know, can you see that clearly?
Yes.
You can, lovely. That means the audience can also see it. What I've done is I've written down what was written at the last live presentation I made. Clearly, it was back in the last year in September. I've written down what people gave me. I'd normally write it there. I put it here. So what are they asking? Have I got enough in the right place? And when can I spend it? And should I spend? And how should I spend more? Inheritance tax. I want to pass my estate with the least amount of burden. Selling my business. I want to do that tax efficiently. Paying less tax. That's about on a daily basis. So they want an ongoing process to annually pay less tax. Where's the money coming from? Should I pass away for the inheritance tax? Will I get fair value for my business on a fire sale? Am I actually aware of it all? Can I protect my assets from the next generation? Personal corporation tax efficiency. Second generation planning, meaning that if what I've done myself to ensure my life's work protected, can we make sure that the next generation have that in place as well, so they don't lose it all? Second generation planning. What's going to happen when I pass away? Who's going to hold the hands of the executors to implement my planning? ISAs and investments, can we put them into trust? Should we put them into trust? Enjoying retirement, how am I correctly funded? And what about getting a decent return on my capital today? You all know about what the banks and building society interest rates are. Sometimes people forget about getting return of capital. So in the race to try and get more return, you don't want to lose your capital in that race. So be aware that for me, I balance that clearly in my mind when I'm talking to people. And what are people's worries and fears? Well, I'll tell you what their worries and fears are. Will my life's work be lost to a divorce? Will my life's work stay in my bloodline? My children, my grandchildren, my bloodline? Will my children be able to figure out how to deal with all of this in the event of death? What about retrospective tax changes? How does that affect me? Double taxation. What happens when you've done the best planning, some planning, or let's say no, whichever way, a tax bill has been paid, and now my family inherit my assets? What about them paying tax again? So double taxation. Will I have enough money for standard of living? And the capital and cash that's accumulated in my business, I'm worried about that. I've got this capital and cash, and they may be worried for a number of reasons. They may be worried that we're not getting the right rate of return. They may be worried that what happens to that money when we're going to try and take it out? What's the tax rate? What people often forget about is what happens to that money when you come to sell your business and how that's going to affect your business, which I'm going to touch on today. And then finally, what about all of our assets if we end up in nursing home, or if after we pass away, our spouses end up in a nursing home? So, when it comes to this topic, you can see there's lots of variables. And frankly, ladies and gentlemen, everybody has a unique circumstance. Some people may have one child, some people may have a number of children, some people may be married, some people may be cohabiting or single. Some people may have children in difficult relationships or themselves be in difficult relationships, and therefore the planning has to cater for each and every individual. So we build our planning, our recommendations based on your very own circumstances. And of course, today, I expect that we've got three types of people in our audience. Those of you who have done it all, congratulations. I truly mean that. I'm really wonderful to hear those of you who've done everything, you've got it all sorted. Well done. You're in the minority. Next, those of us who have done some work, but we are wondering, is it correct? Is it up to date? And does it utilize all the tax breaks? And finally, the third ones who are simply too busy. This is so often the case, I find, with entrepreneurs, people who own their own businesses. They are so busy in their business life. They probably have more time allocated to the business life than they do to the family. I'm really sorry to say that, but I absolutely get that. I will say I am guilty of that to some degree myself, so I do understand it. But those of us that are too busy, that's how picture's going to look for our children, our spouses, our grandchildren. If we don't plan properly, that could well be the look on our own face, but could well be the look on those that we leave behind. So let's move on to the 3 areas we want to talk about today. Retirement. So how do you make sure you're funded correctly for retirement? Ladies and gentlemen, it's very difficult to try and work that out, to sit here with a pen and a piece of paper to try and work this out. It's so difficult. So I think, let me give you a simple example of a case that we worked on early last year. I think it was early last year. And I asked the gentleman, we've changed the names, and we'll tell you, but I asked the husband and wife if they didn't mind if I could present their case, but obviously make it anonymous. I call them Mr. and Mrs. Patel, as you can see, but these are not their names. So we have Atul, who's age 56, his wife Jilpa, age 55. They both work in their pharmacy business. They've got 2 children, 22 and 20, who are both studying. They have potentially a daughter who wants to do pharmacy, and they may want to pass their business to their daughter. They'd quite like to leave that opportunity available. Next slide, please. Their current circumstances are, I have to get a bit closer because I can't see it from here. Their current circumstances are that they've got £203,000 in a few savings. They've got £97,000 cash in the bank. They've got about £270,000 set aside in pensions. They own their own home at £450,000, have a small mortgage, £187,000 mortgage, but the business is worth about £1 million. They have a nice and successful business. Their income between the two of them is just a little over 50,000 each, so it's just over 100,000 between the two of them. So it's about 102,000. Their expenditure, they've told me, is to run the house and run their personal life. They spend about £2,500 a month. The mortgage, they're paying quite a lot into the mortgage to try and get it paid down, is £23,000 a year. And the biggest savings they make is they do maximize their 2 ISAs. This was prior to me arriving. They were already doing that. So basically, they're spending everything they've got. Now, what they told me was Atul and Jalpa want to retire in 10 years. Atul's 66, her 65th birthday. What they'd like, as you can see, ladies and gentlemen, they have a reasonable income, but they save £40,000 of that a year into the ISAs. So therefore, when they now get to retirement, they do want to spend some money, and they want to spend it freely, and they want to enjoy their life. They want to travel. They haven't traveled a lot. They really want to travel. So they told me they want 80,000 net of tax income, 40,000 a year each, net of tax. And they'd like that. They've told me until Atil's 85th birthday, so for that 19-year period, after which they're quite happy if the income drops because they won't be traveling with themselves, their family, their grandchildren, won't be traveling, and they're happy if they get £54,000 a year, net of tax between the two of them. And we've made the assumption that they'll die when they're 100, 99. That income has to be inflation-proof. So, based on everything they've told me, ladies and gentlemen, look at that graph. How do you know whether what you've got, have you got enough? Is it in the right place? Will it generate the right income? And will it leave the right amount for my spouse when I'm gone? Very difficult to tell unless you've got the right technology, right systems and tools. So what this is showing you here, ladies and gentlemen, is Atul retiring. The beginning of the graph is Atul retiring and Jalpa retiring together. And sorry, this graph is showing us where they are today, how their assets are growing. Why are their assets growing? Because they're paying into their pensions and ISAs already. When they retire, and then they start the spending plan. So you can see the spending plan. But look what happens. There's a crossover period, and it goes into red. Next slide, please. That crossover period is age 82. What it is saying is that their savings, investments, and their current pensions all going to run out before they pass away potentially. Age 82. Next slide, please. What this slide is telling you is with using the right technology, understanding you first. What have you got? What are all the assumptions? What are you paying? This is all telling us what they're already paying. So the company was already paying for both Atul and Jalpa £1,000 a month each. So what this is telling you is that we have recommended Atul pay another 27,700 per annum. Next one. And Jalpa pay another 27,600. Both of the two new contributions, in addition to what they're paying, company should pay. And by paying that, what happens? Look what happens. The former position was the dotted line. The dark blue position now is where they're at. Ladies and gentlemen, that is the power of knowing your numbers. Having some appropriate assumptions put in place and working on that plan. Now, this plan, ladies and gentlemen, was created at the beginning when we worked with the client. The plan is reviewed annually at the annual review to make sure things stay on track and kept on track. How family circumstances change. This plan is assuming that they still leave their home and their business untouched. Business to daughter and whoever they wish to leave the home to, I'm guessing it'll be the son. We've done some wills and trust planning around that. So, retirement income, we've talked about that. Ladies and gentlemen, that example was a very simple, basic example. I appreciate everyone has different circumstances. So we can build in everything, whatever you have and how it all works, the money flow, the taxes on disposal of businesses, all sorts of things. A lot of stuff that we can build into our modeling there. Next thing, selling your business. This subject, it's gone to a blank slide, Simon. So if, no, it's fine. I want it to stay on the blank slide because what I'm actually going to do is I'm just going to talk to you now. There's far too many scenarios here for me to possibly go through every single thing. So what I wanted to talk to you about is highline scenario, which is these are the things that I find most common with my pharmacy clients. The first thing is, are you aware the revenue look at any business in the United Kingdom and they classify them in one of two areas. One is a trading business and the second one is an investment business. Now, trading business, if we just talk about that one for a second, because that's the one that we all have. Pharmacy is trading, financial planning, wills and trust planning, it's trading. It makes sense to me. However, did you know that when your daytime activity is the purchase of stock to look after the welfare of the general public by way of medication as pharmacists, that doesn't necessarily mean that your limited company is classified as trading. And the reason is this, ladies and gentlemen, I very often find, I said earlier, pharmacists work really hard and they save quite well. I very often find pharmacists have sometimes created excess capital in their business, so they have more money in the business than they need to run the business. I call that excess capital. And they don't want to draw it out because they don't want to pay a lot of income tax, excessive income tax, because they don't need the money necessarily. So they leave the money to build up on the balance sheet. Now, if they do that, I often find they've done two things. One is they've simply left the cash to go on the balance sheet. They've done nothing. In the last 10 years, your rate of return is disgraceful. It's 1% or less in the last 10 years. Since the last financial crisis, ladies and gentlemen, in 2008, 2009, so it's more than 10 years, it's 12 years now, you know the interest rates were slashed, and they were slashed, and the terminology used was emergency rates. That was the amount of interest they were calling the base rate of the base rate of interest at the Bank of England is called at the emergency rate, and that's been 12 years we've been on the emergency rate. We are currently technically in a recession, and I don't see sight of interest rates going up to a decent level for you to consider you're getting a return on your money in the near future. I don't see sight of that. The Bank of England cannot do that because the economy just simply won't allow it. So therefore, ladies and gentlemen, if you are that person who's kept money on the balance sheet, you have a problem. And or some of you will have said, I'm going to invest the money and I'll use the company's money. Why? Because if I use the company's money, if I don't take it out and invest it myself, I don't have to pay any additional tax. So if the money's on the balance sheet and I just change it from Barclays Bank to a property, which is often what I find, there's no additional capital gains tax, corporation tax. The property is owned by the business. It's rented out to whoever. And of course, the rent comes into business. Here's the challenge, ladies and gentlemen. The revenue have a ruling when it comes to retirement. So selling your business is the area we're talking about right now. And the rule they look at is there's two rules. Number one, when you look at your turnover, how much of that turnover is created via your trading business? Now, even if you have £1 million worth of property generating 50,000, 60,000, 70,000 a year, that's being paid into the business, more often than not, that isn't going to be a problem. Why? Because if your turnover is £1 million on the NHS, private and over the counter, all that stuff, your turnover is significantly more than your investment income. So as long as your investment income is not more than 20% of your trading business, you don't have a problem on that front. However, when you look at your balance sheet, now, there's an important distinction to make here. The balance sheet that you see when the accountant prepares the figures every year is not the balance sheet I'm talking about. I'm talking about when you sell your business. I don't care particularly, and forgive me for saying that, but the reason I'm explaining it, it doesn't matter what's written on your balance sheet for accounting purposes. What happens is the day you sell your business. The day you sell your business, if you happen to sell your business for £1 million of goodwill, stock and debtors, whatever it may be, but you've got £1 million worth of property in there, of course, you're selling your business. You want your property and your cash out. The second rule is the balance sheet rule, and that's also a 20%. So if you have more than 20% on your balance sheet on sale, this sale figure plus whatever else, that's more than 20%. So if you sell your business for 100, if you sell it for £1 million and you've got more than 200,000, or you've got assets way in excess of 200,000, you may not be able to get the relief you get when you sell your business. What's that called? It's called entrepreneur's relief. So on the sale of a business, we are able, in my case, my wife and I are shareholders in this business. We have equal shares. If I sold my business for £1.5 million, which is what I think the value of it is, we would get 750,000 each, and we would claim entrepreneur's relief on the whole lot. Why? Because I don't have in excess of 200, 300,000 on my balance sheet. It's not far off it, but that's where we are. So we'll be okay, Deepa and I. We'll be able to claim the full 10%. We'll be able to pay only 10% tax on the 1.5 million and the 200,000 that's coming out, by the way. In our case, we'll only pay 10% tax. What would happen, however, if Deepa and I were selling the business for, let's say, 3 million and we had $1 million of cash? The first thing is, if we're selling for 3 million, you can only claim entrepreneur's relief on 2 million anyway, in any case, 1 million each. So that third million would be taxable at 20% rather than 10%. However, we may not be able to claim entrepreneur's relief at all if the cash balance is so high. So the point I'm trying to make to you, ladies and gentlemen, when you come to retirement, if we just look at the sale of the business, if you're about to receive £1 million of proceeds, instead of paying £100,000 of tax, you might end up paying £200,000 of tax. So this is really important when we're talking about these kind of things. Why? Because as in Jalpa and Atul's case, they decided we're going to pay more into pensions. You'll remember they had 10 years left to retirement. Let me tell you what happens in their case. In their case, the contribution extra the company is making, they actually receive every year just over £10,500 a year corporation tax relief by making that extra pension contribution. That's the first thing. In your case, if you're more senior and you have more money set aside, you can make bigger contributions subject to allowances. But firstly, in their case, they save £10,500 a year in corporation tax. As they're planning to do that for 10 years, that's £105,000 saving in corporation tax. When they come to either selling the business in the event they don't pass it to their daughter, or selling the business to their daughter, they haven't scuppered the entrepreneur's relief on their sale of the business. So there's lots of things to take into account. The other thing also, ladies and gentlemen, to take into account, when you do retire and you sell your business, and if you do have excess cash, where is that money coming? It's coming directly into your personal bank account. From your personal bank account now, remember, whatever, if you invest the money in properties or whatever you choose to do with it, the reality is it's now fully inheritance taxable. If you die when you have a business in place and it qualifies, and whatever value of it is trading, now forget about entrepreneurs, whatever value of it's trading, that can pass to your estate inheritance tax free. So now we've put a line through the business. All the assets now are in your personal column. There's a come to your bank account. The whole is inheritance taxable. In Atul and Jolpa's case, what they liked the idea of was they were taking a little skim off the top of the business, paying it into the pensions, claiming the corporation tax relief, which was significant over 10 years. But that money now in the pension scheme is inheritance tax free. Not all pension schemes qualify for that, but certainly how we advise, we would always make sure that it's done. So, talking about taxes, inheritance taxes, how is it that we do ensure that we set up our affairs such that we pay the least amount of tax to the revenue on our passing and ensure the maximum stays with our family? Just before I get into that, let me tell you what happens when people don't have wills, because there is, on a number of occasions, I find that people simply have not had the opportunity to get around to doing these things. They don't know where to start, etc., etc. They just haven't done it. I actually act for 2 rich list clients. I don't go out looking for them. They were referrals to me. So that's the reason why I act for them. And you'll be so surprised. These people are worth hundreds of millions of pounds. They pay hundreds of thousands of pounds in audit and accounting fees and legal fees each year. That, these big companies, they pay that. You'd be so surprised that both of them turned up here and neither of them had a will. I was shocking. So if you're one of them, believe me, there's a lot of people like that. So let's seek to remedy that. But let me tell you what happens if you don't have a will and trust in place. Well, here's the first thing. When you have a will and trust in place, basically, you've left the Inland Revenue to make your decision for you. It's called dying intestate. They'll make the decisions for you. And what you're really saying is, to my family, by not having a will, I hereby, to my family, leave several months and possibly years of financial hardship and expenses that were unnecessary to sort out my affairs. To my spouse, I'll leave some of my money, but probably not all of what I own. That is absolutely the case, ladies and gentlemen. If you die intestate, you only leave the first £400,000 of your estate to your wife, and the balance of it has to be split, and etc., etc. To my children, I leave the remainder of my estate, and I give you the authority to enforce the sale of my home if you wish, and realise your inheritance. If we have children, to social services. Unfortunately, both my wife and I have died, and I leave my children orphaned, and I give you the authority to decide who are going to be the guardians of my children in this most difficult time. To the taxman, I leave you to put your hands into my affairs as deep as you possibly can, because they will, because we did no planning. And finally, in the event one of us pass away before the other one, which is often the case, we'll be leaving our spouse vulnerable to the local authority. Because should our spouse go into a home, I'm leaving all my assets, us in here, I'm leaving all my assets to my wife Deepa, because I didn't make this wills and trust, so, and my children, but I'm allowing the local authority to dig into that and take out whatever they need to pay for care fees for my wife. And there's alternative ways of planning for that. So, by not making a will, to my children and grandchildren, so The assets I leave to my children and grandchildren, by the way, I leave that open to divorce. God forbid, should they get divorced, they will lose my assets in their divorce to their ex-spouse, perhaps to their new ex-spouse's partner, and the children that are not in my bloodline. And of course, to the bank and the solicitors. Charge whatever you want, because that's what they will do. And to everybody else, I leave nothing. I think you get the point, ladies and gentlemen. By not making a will, we're leaving an awful lot of legal mess behind us, as well as doing that at the most difficult time. And ladies and gentlemen, please forgive me if you thought I was being a bit harsh in the things I said earlier on. I'm not being harsh. My father died 27 years ago, leaving my mum in a comfortable position. He was 51 years old. We went out one morning to a family event. He was tired. We came back home in the evening, and where he lay down, he died. He slipped into diabetic coma and he was gone. The best death, I'm told by the coroner, the best death anybody can have, but needless to say, at age 51, he was gone. I say again, he left my mum comfortable, but he left her in a terrible mess because he did not make wills and trusts. My best friend, Richard Wodzinski, and I have permission to talk about this because his wife, Jackie, said, I have permission to talk about this. My best friend, Richard Wodzinski, died a little over 15 years ago in a car accident. His wife and his two boys watched him die at the wheel. Real life, ladies and gentlemen. He left his wife, thank God, in a comfortable position because he had done some careful planning. But no wills, no trust. Again, every single year, I'd be saying to Richard, get this done, get this done, I've been saying it for over nearly 2 decades at that point. So, what's changed? What's changed is after Richard died, ladies and gentlemen, I no longer leave my clients exposed to that risk. What people want is they want some form of leadership. They don't always know what should we write in our will. So they need to speak to somebody who's prepared to listen with 2 ears and speak with 1 mouth. Try and understand them and then assist them with a number of options for them to decide what's the best way for us. We need leadership often. Somebody who will help us to make the right decisions because we don't always know. So that's what we require to get this stuff put in place. Next slide, please. So, how can we reduce our estate planning dues and ensure money stays in our bloodline? The way you can do it, the best way to do it, is have a complete protective framework. Complete protective framework starts with the asset preservation. Asset preservation of what? Your home. Primary residence, we preserve that in the first place. Second thing, when we are making gifts during our lifetime, often we help our children, our grandchildren with things. Make sure the gifts we give are not outright, which then sits in that person's asset column, and should they have a divorce, etc., it doesn't stay in our family bloodline. Yeah? So when we make gifts, we can do them such that we can protect those gifts, but they only stay in the bloodline. Next thing, the amount of times I meet people advisors have set up policies, life insurance policies and all manner of policies, but these policies are not in trust. So if you die, they pay into your estate, they pay inheritance tax. So this is crazy. Imagine setting up a life insurance policy for 100,000, 200,000, 300,000 to pay a mortgage off as an example. Husband and wife die, 100,000 comes in to pay the mortgage off. Taxman says, I'd like 40% of it before you pay the mortgage off, please. So we make sure, let's get these life insurance policies put in trust. Next thing, pensions. Today, we live in a fantastic world of what we call flexible pensions. But if you have pensions that are quite old, often they don't fall into today's tax regime. The products were bought at a time when today's tax regime did not exist. And therefore, those products need to be upgraded. That's all that needs to happen to make sure that should we pass away before spending our money, our asset can pass as tax efficiently to our family as possible. If you don't do that, these old style pensions on our passing will fall into our taxable estate. And then finally, of course, many of us will have other assets, residual assets, buy-to-let properties, etc. And of course, if we die before our time, we may still have the shares in our business. So what I'm saying is that we can help you create a framework where we protect all of those assets as much as we can. As much as we can. That's the objective of this plan. How do you do that? I'm showing you one simple example here of a husband and wife who own their home. Many of us on this call may have bought our home a few decades ago. And if that's the case, often you'll find you bought your home jointly. Jointly means, in many, forgive me, ladies and gentlemen, if some of you are not married, etc. I'm just kind of trying to use a terminology that we all understand. Where there's a husband and wife who own a property jointly, it does not matter how much clever planning I do for you. On death, that property has to fall, the ownership has to fall to somebody else. So in my case, my wife's name is Deepa. If we own our home jointly, it doesn't matter all the planning I've done, she will end up owning that property. Now, what is it that I want to happen? Well, actually, what I want to happen is I do want her to have the right to live there and the right to sell it if she wants to, and have the right to use her proceeds and the proceeds from mine share to then buy the next house, etc., etc., if that's what's the right thing for her to do. However, by having joint ownership, she will own the entire asset. By separating the ownership, by creating what we call severance of tenancy. What it does is Deepa owns my home 50%, I own, or our home, I should say. Deepa owns our home 50%, I own our home 50%. So now when I die, my share of the house will fall into a family trust, and depending on the value, I might need more if it's quite a big value, the residue of the value will fall into an interest and possession trust. So firstly, the share of my house will fall into my nil rate band and my residential nil rate band trust. And if the value of my home is a lot more, it'll fall into another trust. Now, what that means, ladies and gentlemen, is that in my case, when my mum passed away, when my dad passed away, my mum was only 46 years old. She didn't get remarried. She stayed her whole life single, and she's now 70 something. I look at my mum and I have to say to you, ladies and gentlemen, that, you know, I think there's been a massive commitment from her. And at this age now, living by herself, it's a lonely life. So I'm only sharing my own circumstances so that you get a perspective on how I've done my planning. I said to my wife, should I pass away? I think in today's world, because from this Asian culture, often people think weird things, but today's world, carry on and make your own life, and you should do, and you know, this is how it should be. Whether I say that or not, she'll do whatever she wants. But here's the thing, ladies and gentlemen, if she did not make quite as good choice second time around as she did the first time, then all the assets that we built together could end up in a divorce court, again, on somebody else's balance sheet. So here's the important things to do. Next slide, please. Next slide, Simon, please. Lovely. The important thing to do is that we equalize our assets. So how do you do that? Joint properties, buy-to-let properties, your business property if you own it yourself, and your home, you equalize the ownership, severance of tenancy. The next thing, if you have £100,000 in savings, don't keep it in a joint account. Move it into two single accounts. Have your, you know, if life is such that you want a joint account, because that's how we run our home, have the amount in there that makes sensible. You know, maybe perhaps a £10,000 float or whatever it is, £20,000 float, plus your income coming in and spend from there. But then when you push the money to the deposit account, push it equally. Why? So that if I pass away, my savings account can fall into a trust. Deepa can still access it, but it's protected now. Next thing, investments. Make sure they're separate, not together, as in not joint investments. Make sure they're 50-50. And your ownership of your business, you may wish to consider having that equally. Why? Again, when I pass away, I want my assets to fall into trust. People can still access them, but it's protected against a number of things. Next slide, please. What I'd actually like to do, ladies and gentlemen, now we're running on. I appreciate that we haven't got much time left, and I wanted to share with you my wills and trust planning. So I'm going to fly through it at a really fast pace so that you can understand where we're at. So, just give me 1 second, ladies and gentlemen. This joke can give me something, please. I'll do it in a second. I'm sorry, I lost the camera there, so I couldn't see where we were. Right, let me make sure that you can see this. Right. My home, ladies and gentlemen, it's owned 50-50. Severance of tenancy. Like some of you, I happen to have 3 buy-to-let properties. They're all owned 50-50. Life assurance. Both of us have life assurance. Both of us have pension. ISAs. And of course, we have a business, which I've mentioned, I think is worth about 1.5 million. That's what I think. So, if I was to die, ladies and gentlemen, what happens to my share of my estate? Now, in my case, my home's worth about 800,000, and I think I have about 250,000 outstanding on it. What happens is, this half share of the house will go into my family trust. Half share, £400,000 worth. There's a mortgage. What's going to happen? Well, the life assurance is all in a trust, and the life assurance will pay. We want to clear the mortgage, £250,000 to pay that out. Yeah. However, the life insurance will not just pay the mortgage off. What the life insurance trust will do is it will loan Deepa £250,000. Not give it to her to pay the mortgage off. It will loan her. I'll come back to that in a moment. So then, as you can see, all the life insurance is in trust. My pension will go to Deepa in a pension account called a nominated pension. Why? Because if I was to die, I want that money not to go into the bank account, so then it's available to inheritance taxes or a challenge with remarriage or anything like that. It'll go into another pension account where she can draw it from that. If I die before age 75, ladies and gentlemen, this is another important factor. Old-style pensions don't allow modern legislation. My pension will allow that money to go into a nominated pension account where Deepa can draw any proportion of the money with no income tax to pay whatsoever if I die before age 75. If I die after 75, the money will still go across, except she will have to pay income tax at her marginal rate. ISAs. My ISAs, because of the value of my estate, will go into something called an interest in possession trust, as will my savings accounts, etc. Finally, the business. The business will fall into a business trust, ladies and gentlemen. So, if I was to die tonight, you can't sell the business like that. But what will happen is the share certificate, 750,000 share certificate, will fall into a business trust. If then, 6 months, 12 months, a year down the road, the business is sold, the share, because my business qualifies for, it's a business property relief, so it's tax-free on death. If my shares fall to Deepa, she sells the business, she gets 1.5 million in her bank account. Wrong idea. Too many shoes to buy. She loves shoes. I'm kidding. 750,000 will fall into the trust bank account, 750,000 in her personal bank account. This is really important, ladies and gentlemen, because if she had 1.5 million pound on the sale of the business, what's she going to do with the money? She's going to invest it in something. What if that's not inheritance tax free? More inheritance tax for the kids to pay. What if she gets remarried, etc., etc.? So, if at least my 750 falls into a business trust, then her 750 falls into a bank account. At least I've protected my bit, and if she wants to spend My bit, after she spent her bit, then she takes loans, as we talked about with the trust. The trusts have the power to loan money to her so that when she passes away, whatever she leaves, we have two sons, whatever she leaves to her, our sons from her death, if it's taxable, the boys can say to me on revenue, my mother had loans to offset against that. She borrowed £250,000 from this pension trust to pay its mortgage off. She owes a pension trust, life insurance trust. Over the years, she took £50,000 a year out of one of these trusts in order to live her life. She owes £500,000 to that trust. So these are all debts on her estate. So, ladies and gentlemen, can we get to the next slide, please? So I've touched briefly on how she can access the money. Once the money goes into that trust, then the kids don't pay inheritance tax on this trust. This one, ladies and gentlemen, I don't have time for it today, but this one does have the potential to pay inheritance tax. But I need to talk to you individually if you want to talk about that more closely. But a large proportion of my assets are protected against inheritance tax for my children and my grandchildren for generations to come. There's no further tax to pay, and it's protected against divorce, remarriage. If Deepa ends up in a nursing home, all of my assets are in trust. The local authorities cannot ask her to liquidate those assets to pay for her care home fees. She has to spend her own money, and when she's out of money, of course, I would want her to be in a good home, not a rubbish one. The local authority is not going to pay for that level of care, so the trustees can top up. After the local authority paid their bit, they can top up discretionary to make sure she's in a good home. Next slide, please. Right, we're at a place where we have questions and answers. So, Simon, if you could get up the chat box for me, because I can't see it. Hang on, maybe I can do it myself. Here we go. Right.
Can you see that, Ashwin?
I can see only, hang on, there's a fourth one that's come in. What are the charges for using trust? Trust charges, are they annual? I said, do they count part of your estate? Right, great. Question number one is, what are the charges for using a trust? Right. There is, the way we set our trust up, there is establishment charge for your wills, trust, and estate plan. There's an establishment charge. After that, there is no ongoing charge. If, however, when you pass away, assets fall into that trust, there needs to be a bank account that's opened, assuming it's cash, or it's turned into cash, where transactions are made. There is no charge for using that trust. However, the Inland Revenue are moving towards, we think in the near future, to saying trusts should have accounts made. So you may have a small accountancy charge on each trust that have assets in the future. Today, that's not a requirement, but that's the only charge that I'm aware of that you could have. Of course, if you have professional trustees, they might want to charge you for their time if you did that. In most of the circumstances that I do with my clients, they happen to use family members because that's who they want in charge of their money. Annual charges for trust. So we've talked about that. ISAs, do they count as part of your estate? ISAs, if they are cash or stocks and shares, yes, they're part of your estate, but you can buy assets within an ISA that are 100% inheritance tax free. You just need to know where to find them and buy them if that's the right thing for you. Debts to the trust, do they have to be paid back, by whom and when? Right. So I have definitely got circumstances where I have got people who are drawing assets out of a deceased partner's trust, and the trustees are the ones who will decide when they want the money back and from who. Largely they have to come from the person who's had the loan. So far, I haven't had a trustee ask for the money back. The plan is that the trustees will ask for the money back on the death of the recipient, the second person. So I think that's really interesting. What are your charges for this planning? I really can't tell you because it's very individual. It depends on how many trusts you have, etc. I should say to you, I've doubled up on all my trusts because I want both my sons, when Deepa and I are gone, I want them to have their individual trusts so they can do what they want. They don't have to consult each other. I think, unfortunately, I see a lot of families falling out after both parents are gone, and it's often about money. So I personally have doubled up on all my trusts. So when Deepa's gone, the boys can have their individual affairs. I'm really aware of the time, ladies and gentlemen, so let me just very quickly skip through and see what else have we got. Thank you. Umesh said I should produce a guidebook for this subject. Thank you. Can the government trade raid trust by passing laws in the future? Busham, anything is possible, but I think that would be a really difficult one. Raiding a trust. I think that'd be a really difficult one. What are the charges when transferring assets into trust? Okay. Actually, there are no charges for transferring an asset into trust. There may be a charge if you're conveying a property, your own property into trust. Of course, there has to be a legal ownership change. That's a sub-conveyancing cost. But to push an asset into a trust, there's no cost inside the trust to receive that asset. Ladies and gentlemen, I hope. Yeah, I think they were the same. I hope I've answered. Hang on. I'm just going back to see if I've missed anything else. I think I've answered them all. Yeah, I think I have. So, in view of the time, we'll move on.
You have answered them all, Ashwin.
Wonderful. Simon, can we move on, please? Right. So what are the important things? We're coming to the end now, ladies and gentlemen. And what are the important things that you do? Put all your life insurance policies into a life insurance trust. Next. Next one. Make sure all of your pensions and investments are not paying excessive management charges. The assets are invested in a way that where the risk is right for you, that you're not taking ultra high risk simply because you haven't reviewed it for years. Have the risk right and make sure you're getting the right returns. We didn't talk about this during the presentation today, but I wanted to get that in. It's so important to make sure that you have policies that are paying the least amount in charges and that they're continually being monitored to ensure the risk of whatever's on the inside is right for you and that you're getting the right returns. Next one, please. Make sure any existing pensions you have do have that inheritance tax efficiency. So they are a modern style pension that allow all of that, and direct the death benefits of your pension to your spouse using this nominated trust option or a pension death benefit trust if that's right for you. Next one, please. Simon, if you bring them all up, that'll be a bit quicker. If you've got excess cash in your company or assets that don't qualify for business property relief, please take some advice on that. Excess cash, very easy to put it into a family trust. What's a family trust? It's a pension, ladies and gentlemen. Moving your assets off your company trading profit loss account, claiming corporation tax, pushing into a pension. If you leave that pension with money in it when you die, where does it go? It goes to your family. Think about it in an alternative fashion. I have a number of very wealthy clients who will never draw from their pension, but they want to maximum fund their pensions because they want to leave it for the family. It made sense to them to take the money out, get the corporation tax relief, and get it into a pension trust fund. Review your current wills if you do have them, and make sure they reflect your wishes today. Ensure that your will, if you have got a will, does send your assets to the appropriate trust to capture all of those tax reliefs. And it does cover the residential nil rate ban, which has only been available the last 4 or 5 years. You must make sure that your will captures that to make sure that that asset is used in a trust, that allowance is used in a trust. Next one, create a lifetime cash flow for your retirement planning. Make sure you understand where the money is going to come from. And then, of course, finally, ladies and gentlemen, I rarely meet pharmacists who already don't have a financial advisor of some sort. So you need to understand the distinction between a life insurance agent, a financial advisor, and a financial planner. A life insurance agent, somebody who might do your mortgages and things and just sort the life policies out. Great, that's all they do. A financial advisor will often advise you, buy this policy, whether it be a critical illness policy, whether it be an ISA, whether it be a pension, fantastic. They're helping you invest your money. A financial planner looks at the entire picture, does the first two jobs as well, but make sure he understands the complete picture and make sure all of the pieces of the jigsaw puzzle are put together correctly for you. So how do we do that? Apologies, before I say how do we do that, I said in the video that I sent out, there's a 5-step guide that I'm going to leave you with today. Establish, Simon, this is the one thing perhaps, if people do want, perhaps send them this copy of the slide. Establish your current position. Really important. If you'd like us to help you do that, you book a discovery meeting with us. And as I say, Joe's already sent you the email with a response sheet. Joe, will you print a response sheet? Let me have it quickly so I can show everybody. Second one, understand what are your needs and fears. Let's just understand them. Let's get them out there. Why? So that once we understand them, we can do something to protect them, remove your worries and concerns, and achieve your goals and objectives. Third one was obviously, when you have that meeting, that discovery meeting, we'll discuss all the options available to you. And hopefully at the end of that meeting, you can make a decision if you want us to put all of that in writing for you. Number 4, gain confidence. You'll gain confidence once you have a proper financial plan written for you. We might not be able to achieve all of it immediately. It takes time, annual reviews. But once you have a plan that's written for you and you know that there is a systematic review process, you can have peace of mind and gain confidence. You know what? I'm now on the right track and I'm going to stay on the right track. And 5, freedom. Once you've put all of these documents in place and you have continual review, it means you're free. Free to enjoy your life, free to spend your money. That's really important. People often don't feel comfortable about spending enough money on the journey up until retirement because they just don't know what retirement is going to look like. So once you have all these plans in place, you really know how much money you can spend today comfortably without worrying that I'm not going to have a comfortable retirement and I leave anybody else behind me without a comfortable retirement. Joe, have we got that, please? It's just printing. So, ladies and gentlemen, at the end of our session today, I'm so sorry, I just realized now. Thanks, Joe, that's it. If at the end of our session today, you'd like to book a meeting with us, then in your inbox, you should already have this document. 2 pages. It has probably got your attendee name. I'd ask you to do me a favor, which is rate the content and rate how I presented, because today's presentation has been made up of a number of people telling me how I need to improve to make sure I get that message across to you. So please do let me know that. We've got 6 boxes here, which are general areas: wills, trust, estate planning, pensions, investments, tax planning and mitigation, profit extraction, other. Tick whichever of those is of interest to you. If you want a meeting, tick that box and then give us the day and the time when we can best contact you. I appreciate you're busy, and then leave the best number that we can contact you on. If you very specifically have 3 things you want to discuss in that first meeting, please make sure you put that in there. And then on the back, give us your contact details. There's 2 areas for contact details. You may wish to give us your business, you may wish to give us your home, you may wish to give us both. And then make sure you email that form back, save it in Word, and email it back from the email it's come from, Joe's email, or you can even fax it to us. We still have a fax machine. Remember, if you're faxing it, you need to fax both sides. If we have a meeting, ladies and gentlemen, the only thing I'm going to ask you to do in preparation for that meeting is to complete a simple 4-page document. It's very simple. It's called a lifetime focuser. Name, address, contact details, very simple, children's names. Here, it's your income. How is your income made up? Tell us about your properties and what I call real assets. Tell us about your financial assets, bank, building society, ISAs, pensions, pension funds, life insurance policies. Tell me about your loans. Tell me about your expenditure. With regard to your pensions, you might want to give me a little bit more detail. Not a lot more detail, a little bit more detail. But once those 3 pages are done, that's the hard facts. And you can see it's not too difficult to complete that. This is the page I'm really interested in, which is asking you the right questions about your current wills and trusts if you have them. And What do you want me to focus on in that meeting? Ladies and gentlemen, this is your meeting, it's your agenda. You set the agenda, you tell me what you want to discuss, and then you tell me what did my practice and my people, what do we need to do in the first 12 months for you to be happy with our work? The most important thing here is that you get what you want. We deal with the issue you want. And the way we do that, Simon, is we have a process called the wealth management system. And the wealth management system very simply works like this. Simon, love it. Oh, fantastic, Simon. Thank you so much. As you can see, the first box is a discovery process where we send you that 4-page document. You complete it, you send it back, and we book that meeting with you so I can go through that document, and in 60 minutes is how long we have for that meeting. First 10 minutes just going through, making sure I understood what you wrote, and 50 minutes of me talking to you about solutions, how you might deal with these things that you're telling me about. If at the end of that you say, Ashwin, that's great, we want to move to the next place, put it in writing, let's look at it all properly, then we create the wealth management plan for you. So that will talk to you about whatever it is that's important to you, but subjects like estate planning, development of your wealth, protection of your wealth. Next, the final box at the bottom is the implementation. Well then, we've not only given you a report, but now it's got to be implemented. So we'll implement that. But before implementing it, you might say, we've had a little change of thought and we need an additional planning meeting. So you see the box going off there a little bit towards, as I'm looking at it, to the right, an additional planning meeting. Then we can implement, and then we will have annual reviews. So, nearly the final slide. What happens now? If at the end of today, you complete this form and you get it back to us, by the way, that first meeting, we normally charge £287 for it. So as long as this thing is back in my office by the 18th, that's exactly 7 days from today, whenever that meeting is booked, there is no charge. We're fee-based advisors here, so we do things very fairly. There will be no charge. That meeting is at my cost. So if you complete it and get it back to us, as soon as we've got it, and we know when to contact you, Joe Redding, Joe Redding works on my client relationship side. Here's Joe. Joe will phone you or email you or a combination of both to get you in my diary in due course. If, of course, you call back the office and Joe Redding's not available, there's a number of other staff, but Joe Cook is my practice manager. You can always speak to her. So we've got a JR and a JC. We've got Joanna and Joanne. And next slide, please. So what have we given you today? What we've given you today is a number of things to think about. 3 areas that we need to focus on. If we can take those 3 areas in a systematic way by working through these processes and ticking each box off, then you're going to get that peace of mind that we all want. You will have freedom to spend your money today more comfortably, knowing that tomorrow is secure. You'll also know that should I not make it to the very long age, by which time I've spent everything I've got and I've given everything away, but should you die early, unexpectedly, or die having left assets, you will make sure your family have benefited from your life's work, not the inland revenue. So all that's left to say is thank you very much for your time today, ladies and gentlemen. I do appreciate it. It's been a long day. I hope this presentation has captured your attention. I hope whatever you came in to see today, you've got a few more ideas and thoughts. And I do look forward to seeing those of you who wish to see us soon. I know, thank you so much for hosting this session today. And I also want to thank the NPA. They're doing a really sterling job. I've been following the activity of the NPA for a long time. We're obviously partners now of the NPA, but I've been following it way before that. And they really do work incredibly hard to do the very best they can for their clients to keep these businesses as profitable and as streamlined and make your life just that little bit easier by implementing all the ideas you've had over the last 3 days. So I want to thank the staff of the NPA as well. I know.
Thank you. It was really informative. I mean, I think I know quite a bit about these things, but you've even taught me a few things. And, you know, I would just say that to everyone who's still attending, I think it's worth your while filling in those forms and getting them sent off to Ashwin. He really will help you work smarter and not as hard as we all are. We all work terribly hard, but we need to keep the money that we're making and away from the tax man. That's my motto anyway. And Ashwin, thanks again for spending all that time explaining those things. I know it's briefly, but you've covered a lot in a very short amount of time, and very patience. I'm sure our members will find that very useful.
Thank you.
And that's all from us today. I'm sorry we're running a little bit late. If you have any Q&A that you want to ask Ashwin directly, please write into the NPA, or I think he's got his contact details. You can write directly to him or Joe, and he's sent you an email. And that's all from us this evening. So have a good evening and enjoy the rest of the evening. Thank you, everybody.
Thank you.
Fantastic. Good night.